This recording, we're going to finish off IAS 37 by looking at some of the more particular areas or applied areas of IAS 37 in terms of common business scenarios. So the first one we're going to look at is capital provisions. And we mentioned this already in IAS 16, where sometimes the provision will not be expensed immediately to P&L, and it can be added onto the cost of the asset. So for example, relating to IAS 16, you may have a provision, for example, to clean up a quarry at the end of its life or to decommission a chemical plant at the end of its life. And those decommissioning costs, they're essentially a provision. They're not going to happen until the future. But what you do is you take the present value of them today and you add them onto the cost of the asset, and it'll depreciate it as normal with the rest of the asset. So if I take a slide that we had back in IAS 16, it said one of the initial costs that are allowed to be included is the estimated dismantling cost at the end of the asset's useful life. So those dismantling costs could be, if you have a very particular type of piece of equipment which takes a lot of dismantling, that cost can be included at its present value, or decommissioning costs, as I said, for a chemical plant, or environmental costs in terms of rectifying or closing a quarry if you're involved in building materials. So it's a particular one. Now it's quite niche. We won't see it too much in AC 220, but it's a link between IAS 16 and IAS 37 as well. So let's take a small example and we see what it looks like. So companies awarded a contract to build and operate a nuclear power station on the 1st of January 2011, and it's going to come into operation in 2013. The license for 30 years. The construction cost of the power station was 450 million. And part of that agreement to build and operate the station was they have to dismantle it at the end of its useful life. And at 2013, the estimated cost of this obligation, because you have to do it at the end, as part of the contract, a legal obligation, 50 million. Appropriate discount rate to reflect the time value of money is 8%. So this is a present obligation, right? It's going to happen, it's probable, but it's out in the future. And we know from our lecture this week, if the time value of money is material, and it certainly will be because it's 30 years out in the future, well then what we're going to do is we're going to recognize it today. So they're asking you provide the journal entries to recognize the initial cost of the power station and the obligation to dismantle, and the journal entries recorded at the year end 2013 for the subsequent measurement. So let's focus here and we'll bring down and we'll start and we'll have a look. Some of it's straightforward, one or two things can be a small bit tricky. So the first thing is you're going to debit PP 450 million and you're going to credit bank 450 million. Okay, that's what we're told the construction cost the power station costs. Now it might have been over a number of years, so we'll say credit bank or whatever it might be, but it was the debit PP 450. So we'll assume it was just all spent in 2013. So I know it was built over a number of years, but we're just for simplistic purposes. But we'll also have this 50 million. Now you can't just debit PP 50 million because it's not going to be paid until 30 years time. So what we do is we get the present value of the 50 million is 50 million divided by 1.08 to the power of 30. Now I'll put that to the power of. So that's how you get your present value. You can use the discount tables if you wish. You might get a slightly different answer, but again, you will still get your full marks because we accept rounding in the exam like that. So you get your 50 million. Now you can do 50 million if you want, divided by 1.08. Now the problem is here, calculated like this, I don't know if you can put to the power of, or put it to the power of 30, and it gets you 4.96 million. So it's significant. The present value of that today is only 4.9 million. If you want to say 5 million, it's fine as well. We'll put it to 5 million if we round it. Because when you round to one decimal there, it actually rounds up to 5 million. So where is that coming from? Again, use your calculator. Do 50 million divided by 1.08 to the power of 30. Because it's 30 years time. The present value today, 4.96 million. So it's 5 million when you round. And you will debit PP, 5 million. And you will credit provision, which will be a non-current liability. Because again, it's not going to be paid until 30 years time, 5 million. And that's how you do it. You get the present value of it. It's still going to happen in the future. But under IAS 37, when the time value of money is material, you have to account for it. That means you take your present value. So be careful now and understand it. So on the 1st of 1st 13, the cost now equals 450 plus 5, 455 million. Depreciation equals 455 million divided by 30. Now I'm assuming here that there's no residual value at the end. If you're not told anything, you assume, just divide it over its useful life. So depreciation will be 15.2 million. Again, that's rounded from 15.16. They said to round to one decimal. So doing like that is fine in terms of this example. So you recognize the present value of the provision and then you add it onto the cost of the asset, and it's depreciated as normal over its useful life. The other thing to watch, and this is where students go wrong, is at the 31st to 12th, 2013, now the dismantling is only 29 years away. So less impact of time value of money. So what we're saying, we actually have 50 million to pay in 30 years time, but now at the end, the present value at the 31st to 12th, 13 will be 50 million divided by 1.08 to the power of 29, because you're one less year. And you have to do this at the end of each of the years under IAS 37. So that provision now is gone from 5.9 million to 5.4 million. So increase of 0.4 million as the end is getting closer. The end of the project's life, 30 years, getting closer. So that means what we're calling here is you're unwinding the discount. The time value of money discount you've taken here is, instead of recognizing the 50 million, you've recognized 5 million. But as those years get closer, the present value gets bigger. And in IAS 37, how you recognize that is you will debit SOPL finance costs and you will credit the provision, 0.4 million. So what you're saying is provision now at year end equals 5 million plus 0.4 million, 5.4 million. So you update the provision at the end of each period, because at the end of each period, it's getting one period closer to the end of the life of the project. And that means the present value is getting bigger. So in 30 years time, your present value of the provision will match exactly the provision that you'll have in your liabilities. And over the next 29 or 30 years, you'll write it off over finance costs. So for 2014, for example, you'll do that calculation again at the end of 14, just to show you, and it'll now to the power of 28. So now the provision at the end of 14 has to be brought up to 5.8 million. So you'll increase another 400,000 in the 2014 financial statements through finance costs. And you continue on that each year. And as the years go, the increases get bigger, because that's how the time value of money works. And at the very last year, you will have a closing provision in 2043, 30 years time, of 50 million exactly. So that's the key thing. It's a tricky one around capital provisions, and you will see it in the tutorial question next week and some of the questions in question pack 12 of the link between IAS 16 and IAS 37, particularly for likes of chemical plants or large plant and equipment that has to be dismantled, or even quarries. All of those will have those dismantling or decommissioning costs that have to be recognized at their present value. And what we call it then the subsequent measurement, which this requirement is getting at here, the subsequent measurement, is what we call the unwinding of the discount. That every year that you get closer to the end of the life of the project or the asset, the time value of money gets less. The discount gets less, which means you have to increase the provision. That just takes a bit of practice, but it's quite repetitive, and it's a link there to what we covered already in IAS 16. Right. Another practical thing we have in IAS 37 is, well, what about future operating losses? For example, COVID. Now I know I expect to make a loss this year, or I expect to make a loss next year. Can I create a provision for those straight away? No, because again, the loss does not arise from past events, and it could be avoided by, again, closing the business or changing the business around. So you cannot recognize a provision for future operating losses. It's too subjective. And you can imagine there'll be a lot of abuse of that because people might say, oh, I expect to make a loss, turns out to make a big profit. So you're not allowed to recognize a provision today for estimated future operating losses. Just generic losses. There is one or two exceptions, we'll deal with them, but generic losses just because the business is performing poorly, that's not allowed because they're not an obligation. They don't arise from past events. You could avoid them by changing different actions of the business or, in extreme circumstances, closing the business. The other thing, and we've seen a lot of it maybe with COVID and in the last recession, is restructurings. So where you're selling off a business line, you're changing the divisional structure, you're changing business locations. Some of these are allowed in IAS 37 because they're part and parcel of the business and they should be included when they're announced. But what the IAS 37 wants to get around is the whole idea of big bat provisions. What we mean by big bat is if you know there's going to be a bad year, example COVID, you take a big bad year and you put a load of bad news into it. So then when that happens next year, and maybe it's an average year, you can reverse some of those provisions, like we know you can, and boost your profitability artificially to smooth out your profits. So they want to avoid taking big bats. When often this happens is where a new management team comes in and exists in place of an old, they try and take huge big provisions in the first year and blame the old management, and then use those provisions over the next couple of years to say, actually, turned out we didn't need that. They'll reverse it into the P&L then as a credit, which boosts their profits and allows them to smooth out their profits or manage their earnings a lot better, which of course might link back to their bonus. And we had that in the IAS 36 tutorial last week around earnings management. So you can only recognize a restructuring costs if there's a constructive obligation. Rarely there's a legal obligation because it won't have any legal binding. But for a constructive obligation, you must have a formal plan. Clear plan in terms of what the restructuring will involve, redundancies, moving offices, and it must be communicated. They're the two key criteria. So if you have a plan in place and you communicate it before the year end, you can recognize an obligation. If there's no detailed plan, or you haven't raised a valid expectation, by meaning you haven't announced a restructuring plan to staff who are impacted by it, then it's not allowed to be recognized at the year end. So there's certain criteria to make sure it's a valid plan and to make sure there is a formal plan, not that it's just this subjective figure that you're trying to put in to manage your earnings, that there's clear evidence that it is a legitimate plan and that people are made aware of this plan. That's required to debit expenses and credit provision. What can be included? The remuneration of employees who are costs to maybe dismantle the plant, get rid of surplus stock, redundancy costs if people are losing their jobs, or you might have costs to terminate leases or other contracts, for example, maintenance contracts, if you're leaving a particular location and you're not going to be operating from then again. There are, however, certain costs that are not allowed to be included. You can't put in relocation costs or retraining costs. Cost of investing in new IT systems or marketing costs for a new, maybe a brand re-image or something like that. None of those are allowed either. Right? They're not allowed to be included in restructuring costs. And any impairment write-downs of PPE, again, they go into other standard IAS 36 linking to IAS 16. So the reason IAS 37 includes so much detail on this is it was very much been abused in the past, where companies were taking artificial restructuring provisions, pretending they were planned restructuring, and it never came to fruition. And 2 years later, they'd say, "Oh, our plans have changed," and they'd end up reversing the provision out. And it ended up manipulating the profits artificially, and use the financial statements couldn't get any credibility then in terms of the profit figures that were shown. The other last one, which is quite relevant now in context of COVID, and particularly with lockdown, is onerous contracts. So you have your contract, you have unavoidable costs, meeting the contract or more than the expected benefits. One obvious one here is leases. So for example, you have a lease, maybe Grafton Street, you're in lockdown, the store is shut, and you decide, look, we're shutting down. We're not going to stay on. We can't. And that's a common scenario, unfortunately. But the problem is the lease is still there. That lease could be a 30-year lease in Grafton Street with the owner. So the difficulty is there, that lease still has to be paid. That is an owner's contract because you're getting no benefits from it. Now you might be able to sublet it, but maybe you can sublet it for less than what you're paying for it. So you can value that owner's contract. You figure out how much are the unavoidable costs, the amount that I have to pay on the lease for however is left in it, the unexpired proportion, and you can recognize that as a provision for today. So even though you may not be paying the lease payments until next year, the year after, if you have a contractual obligation to pay the lease payments and it's an owner's contract, you're not actually going to see the benefit because you're not using that property anymore, but you've signed it up to it, then you can recognize those onerous payments today. Debit, lease expense, credit provision. And you're more likely going to recognize it at its present value if it's a number of years. Now that's very relevant for companies, particularly in the retail sector, who have very expensive rents and maybe they're no longer operating out of those locations, but they still have a contractual obligation with their landlord to pay the rents. Now, don't worry, we won't get you to value many of those. They're quite niche. They're more so professional exams, but just to where it is covered in the standard. And you can, in terms of IAS 37, recognize those. So, for example, where a company has a lease in a warehouse, they've now decided to use warehouse B, but they can't cancel the lease in warehouse A. They'll recognize the provision for the best estimate of the cost of the lease. And what that best estimate will be is what's the remaining life in terms of years of the lease. Maybe it's 5 years, 10 years, how many payments each year. And they can recognize that today when the decision is made to actually um, not use that warehouse anymore. And some of you might say, well, sure, that doesn't really make sense. Why are you front loading it all? Well, once you figure out the bad news, it should be communicated through the profit and loss statement. You shouldn't wait and then pay the rent every year, whereas there's no benefits coming from it. So it must be disclosed and it must be accounted for as a provision. That's one of the key criteria, specific examples in IAS 37 around onerous contracts. One good example in more recent times, this is from the year and a half ago at this stage, just over a year ago, sorry, 2020 February, AIB made another 300 million provision over the tracker mortgage controversy. So they realized there's a lot of controversy in a lot of the banks around tracker mortgages and people not being given them or taken off them. And they've announced an update that they realized they looked at their best estimate and their best estimate is now 300 million larger. And that would have taken an expense. You can see it here if you want to go through the link and look at it yourself. And now that half year report may not be on loop. I just don't want to open up here. We can see I don't have it open here. Just to double check, but you can find it if you want. You go to AC220. It gives you a good example. It's available in the link anyway to work your way through. I might not have uploaded it. This one. Yeah, I haven't uploaded, but it is. Just take off that. Doesn't confuse students. You can go on here, which gives you the updated press release, and the AIB half-year report will be available there as a link as well in the AIB financial statement section. But it just shows you that's debit expenses 300 million. It's a 300 million to their profits in that particular financial statements and credit the provision. So their best estimate has been updated because even though they've used some of the provision and paid mortgage holders their compensation, they've done another analysis and realized there's 300 more. That's the application of IAS 37, where you're increasing your provision because you've realized we now have legal cases. They may not be legal cases yet, but they have a constructive obligation because they've done this for all the past trackage mortgage holders as well. So it's a good real world example of where IAS 37 comes to play. And you will see it a lot more now in the more recent financial statements of companies to do with COVID, where they're looking at restructurings, they might be looking at redundancies, and they might be looking at owners' contracts, particularly lease contracts for many retail units. Glanbia also provides a good example on Note 27. So if we come down to Note 27 here, Note 27 provisions. So they have 3.6 million of provisions in total, but see the way they break it down. You have provisions with respect to restructuring, and they tell you example restructuring of what happened, an ongoing review of their nutritional segment. Then you have legal claims, which are all utilized this year. So they're opening balance and they used them this year, they paid off. Legal claims represent legal claims against brought the group, and they were all settled this year. So they would have removed them all. Property and lease commitments, note C. This relates to remediation work on reinstating a property to its original condition. So there's uncertainty around the timing and nature. That's like a capital provision. See the way the unused amounts reverse in the year and they've utilised during the year. Then you have operational provisions, see note D, for assurance claims, because there's uncertainty. And then you have regulatory provisions, significant one, 22 million, and that relates to interest and penalties from certain tax, UK tax and UK pension provisions. So it's interesting to have a look through the provisions in each company just to get a sense of what type of ones they have. The other one that might be interested in looking at would be, for example, here, CRH, because remember they're a buildings company. They might have some quarries and whatnot as well. So if we see, can we get provisions on the financial statements? You're looking for in liabilities. So the balance sheet, liabilities, provisions, note 28, and provisions, note 28, current and non-current. So if we take a guess here and we see, can we get to note 28? Not too far off. There's your provisions. You can see here they have insurance provisions, environmental remediation, and redundancy provisions and other. And each of them are explained. So it gives you an idea, and then they've just done an opposite. They've how much has moved during the year all here. And if you come down, particularly this one, the environmental remediation, number 2. This combines obligations governing site remediation, restoration, environmental works in compliance with local and environmental regulations. So constructive obligations stemming from past practice. So it's legal, but also constructive obligations. Significant element of provision will reverse in the medium term. Those legal obligations to long-lived assets, for example, mineral-bearing land, i.e. quarries, will unwind over 30 years. And they discount them using the expected cash flows. That's what we've just done with one there. So they're saying particularly mineral-bearing land, which is essentially like your quarries, that you're quarrying out building materials. Look what happens. They have environmental redundancy. The opening balance is 484. Now there's some FX translations, don't worry about that. They provide another 41 during the year. They use 26 of it, but look at this. They're unwinding the discount. They're ones that are using over a number of years. You will credit the provision, what we're doing here, increasing it, and you'll debit finance costs in the P&L. So that's a very good example of companies that have capital provisions. The obvious one, CRH, is your mines or your quarries. Right? So it's a good one to read through in terms of what they have. Then you have redundancy programs, and they talk to you about those. And then other provisions relate to legal claims, owners' contracts, or some warranties or guarantees that they might have given as well. So it just shows you there has to be all that disclosure around IAS 37. So Glanbia and CRH are two very good examples of that. So this slide just gives you a summary in terms of the key criteria for IAS 37. Greater than 50%, you provide for a liability, create a provision, but it must be greater than 90% for an asset. Now, I think the old slides might have said 100 there. I think 90% is probably a better benchmark. Once it goes above 90%, you can assume it is virtually certain. That's just an idea, get in your head. If it's only a remote chance, which is less than 10%, very unlikely to happen, you don't even need to disclose. So it's a less criteria in terms of if it's a very off chance that it will happen, you don't have to disclose. It must be possible to disclose for liability. It must be probable to disclose for an asset. So there's higher threshold in each one for disclosures and also for recognition. So then your disclosures, like we've seen already, show the opening closing balances, the amount reversed, and also there's an exception of limited disclosure if that information will be prejudicial, which means it's going to impact your prospects or your chances of winning a live legal case. But you must disclose that fact on the cases, on the note of the accounts. So you can see all of that when you look at Glanbia's and you look at CRH's, you'll see all the types of disclosures that are given. It's a very common one that's used. Have a look at another couple. Look at Ryanair, for example. Look at Tesco. What type of provisions do they have? Just so you can see all of that is coming from a single standard, IAS 37. And these are all your disclosures, which we've talked about before. So what I've given you as well is a little flow chart to give you an idea, well, how do I distinguish whether it's a provision, whether I disclose it, or whether I do nothing? So that might give you a nice idea to visualize what you might be struggling already with in terms of what the key criteria are. Something that might help some students get their head around it. In terms of the difference, they're the exact same between International Accounting Standards and FRS 102. Same frameworks in place, so we need to consider concern yourself too much about that. So if you do want to read a chapter, as I mentioned in the live webinar, the Darcy textbook is the best starting point. Chapter 30, have a look at the slides and of course the question pack 12. We will have a tutorial next week which will cover IAS 37 and give you a couple of examples. Not the hardest of standards, quite frequently asked in exams, particularly in question ones, which is an IAS 1 question, and it's just the good students will be able to reference the relevant standards and also the relevant criteria in that standard as well.